So I suppose the first question really is, what is a run-on strategy and why would you want to do it? So a run-on strategy is aiming to run a pension scheme in a highly secure manner with low levels of risk as well, but explicitly aiming to generate surplus over time for the key benefits of the stakeholders. So what this could mean is improved retirement outcomes for members, could also mean real financial benefits for sponsors, and also there's clearly some overlap between the two in terms of mutual benefits to both. Now, I'm not going to be focusing on these points here, talking about the benefits. What I wanted to focus on is some of the considerations that need to be taken into account when thinking about designing investment strategies and portfolios for these kinds of objectives. So traditionally, under a traditional investment strategy, we would have a scheme that's looking to take return or target some risk in order to close a deficit. It will probably be looking to do so in a low-risk manner with a view to de-risking over time as well. But importantly, when full funding on that end-game objective is achieved, the scheme will be looking to de-risk fully or to the extent possible. So in this graph here, what we're showing here is the low dependency funding level in white and the buyout funding level in green. And what we can see here is that when full funding on a buyout basis is achieved in around 5 years' time, the scheme is looking to de-risk. And that's reflected in this white line here. So there's no improvement in the funding level on that low dependency basis. We're not targeting a meaningful return in excess of that. But importantly, what we can see here is that the buyout funding level continues to improve. And that's as a result of the scheme maturing, members retiring, and therefore buy-in, buyout pricing continuing to improve. However, under a run-on approach, a scheme is probably looking to target a buffer in excess of some agreed prudent funding measure. And in the example that we're showing here, this is 105% funded on a low dependency basis. Now, instead of de-risking at the point at which this is achieved, the scheme will continue to generate a return or target a level of return. And in this example, we're looking at gilts plus 2% per annum. So a bit of a higher return. But alongside this as well, when this funding objective is achieved, the scheme will start to distribute surplus to the benefit of members and the sponsor as well. What we can see here is that, as a combination of these two things, so distributing surplus, continuing to target return, again, that full funding or 105% funding on that low dependency basis is broadly maintained, but buyout funding continues to come towards you as the scheme matures. And I suppose the key point here really is that over the lifetime of this, over the 12 years here, what we could expect to see is around 1.5 to 2% of the asset value being distributed each year. So a key benefit to members and sponsors in this example. So in terms of some of the considerations around designing investment portfolios and the strategy, I think there are 3 key points that I wanted to focus on. So the first one is that we have the flexibility to build upon the low dependency portfolio. Pension schemes aren't subject to the same kind of constraints that insurance companies are, for example, in terms of allowable assets. So pension schemes arguably have a competitive advantage in terms of the investment opportunities or range of investments that they can invest in. We also need to think about the fact that actually we're building on the low dependency strategy. The cornerstones of the investment strategy aren't going to look drastically different. So, for example, we're still going to have those allocations to LDI and also buy and maintain credit, so high-quality investment-grade corporate bonds. But the way that we think about risk needs to change. So instead of thinking about taking risk to close a deficit or the ability to de-risk over time, or incorporating assets that are aligned with how an insurance company might price a transaction, and indeed selling illiquid assets or running those off over time, we need to start thinking about generating that surplus and replenishing it over time. So actually we're starting to think a little less like an insurance company and maybe a bit more like an endowment. So in that respect, we need to start thinking about balancing the level of return against mitigating downside risk. And actually, based on some of the analysis that we've performed, we think targeting a return of around gilts plus 1.5% per annum to 2% per annum should lead to better outcomes versus much lower risk investment strategies. And again, we want the probability of introducing a deficit, in particular on a technical provisions basis, when contributions may well have to recommence, to be very remote. So we need to start thinking about how we can mitigate that kind of risk. And the final point I wanted to make is about retaining flexibility. So yes, we have a competitive advantage versus insurance companies, and we can make use of that longer investment horizon given we're running on the strategy, but we don't know what the future holds. Regulations may change in the future, and that may mean that run-on strategy is less feasible as an end-game objective, and buyout might become the most appropriate kind of objective. So we need to retain flexibility should circumstances or objectives change. So in that respect, what could a portfolio look like? So again, sort of building on the low dependency portfolio, we've got those cornerstones of the investment strategy in terms of allocations to gilts, LDI, as well as that buy, maintain credit portfolio. And this portfolio is targeting a return of gilts plus 1.75 to gilts plus 2% per annum. Now, like I said, we want to be able to make use of that competitive advantage, and that means investing in a wider range of opportunities. So that could mean that we're able to maintain an allocation to growth assets. And this will be everything that we know about a traditional growth asset portfolio. So diversified across equity, credit, and potentially other return-seeking assets as well. The second point we need to think about goes back to that retaining flexibility. So we want to have that flexibility should circumstances change, but we also want liquidity in terms of being able to support that release of surplus framework. The second point is, again, sort of making use of the illiquidity budget, that long investment horizon. And actually, there are many pension schemes out there at the moment that are looking to sell their less liquid assets to try and facilitate a buyout transaction. So schemes looking to run on could potentially purchase these assets at a bit of a discount. In addition, if we are purchasing these assets at a discount, they're likely to be fully deployed already and reasonably mature, and therefore the investment horizon is likely to be slightly lower as well, which can be of a benefit. If we can't access assets in that way, then we could look at maybe short-term contractual profiles for private assets or semi-liquid open-ended vehicles, or indeed there are some more innovative solutions out there at the moment in terms of long-term asset funds as well. The final point I wanted to make as well is, given that longer investment horizon, we can start thinking about investing for purpose. So we could include assets that are explicitly linked to UN Sustainability Development Goals, for example. The final point goes back to that point I was making around balancing return against downside risk. Now, we could use equity protection strategies in order to achieve this. So equity protection strategies use equity options as an example, so derivative contracts, in order to participate in equity upside, but we could actually sell some of that equity upside in order to purchase downside protection. And that can be really useful in the context of maintaining a surplus and, again, mitigating the risk of reintroducing a deficit, in particular on that technical provisions basis. The final point to note here is that these are derivative contracts, contractual in nature, and so we can think about the release of surplus framework in terms of timing the maturities of those contracts as well. So in summary, when we're thinking about investing for run-on portfolios, we've got those key cornerstones, LDI, buy, maintain, but we also have the flexibility to invest across a wider range of assets to help build up that surplus and replenish it as it's distributed. So the key things to think about, again, are making use of that competitive advantage, investing in that wider range of assets, but we need to think about balancing return against downside risk. Equity protection strategies could be useful here. And then finally, we also need to remain cognizant of the fact that circumstances and objectives maintain. So retaining flexibility will also be a key consideration here.